Are interest rates signaling a recession? This has been a really, really hot topic the last several months, about the last year and a half, as we have had an inverted yield curve for pretty much the last year and a half, almost 2 years. We'll get to what that means for the stock market, or what it's meant for the stock market historically, in just a second. But I want to go deep on what you're looking at right now, because it's a couple of lines that I'm telling you are invoking a yield curve inversion. But I want to fully describe what is going on here and what a yield curve inversion is before we even rope in the stock piece. Because in the black line, you have the S&P 500 over the last 33 years from 1990 till present. But that blue line is the difference between 10-year U.S. interest rates from the Treasury and 2-year U.S. interest rates from the Treasury. And with that difference being right now, if you look all the way to the right part of the chart, essentially present day, with that blue line being in negative territory below that dotted line that's signaling 0%, that is an inverted yield curve. Now, what is that technically conveying? Well, the difference between 10-year interest rates and 2-year interest rates is negative, thereby showing that short-term interest rates are higher than long-term interest rates. Why am I looking at the 10-year and 2-year? Well, those are kind of benchmarks for long-term interest rates with the 10-year and short-term interest rates with the 2-year. Could you look at 5-year interest rates relative to 6-month interest rates? Yeah. Could you look at 30 years versus 1 month? Yeah, absolutely. But they'll all show you a similar story, which is yield curve inversion, short-term rates higher than long-term rates, thus showing the difference between them to be negative. And now that you got hopefully a handle on what a yield curve inversion is, short-term rates being higher than long-term rates, what this chart is showing, that the difference between 10-year rates being the long-term benchmark and 2-year rates being the short-term benchmark, that difference is negative. Now we can look at historical instances of just that and correlate it to historical stock market action to see if this current inversion is warranting a stock market crash or a potential recession. Obviously, usually go hand in hand there. And you look at the last instances where we've seen yield curve inversions in the late 90s, early 2000s. Yes, you've got simultaneously the dot-com bubble busting there in 99, 2000, 2001. And then you obviously next see the blue line going negative in 06, 07, and then popping back into positive territory by 08. But in 07 and 08, you have the financial crisis. Fast forward to today, that blue line is even more negative than it was in those times. And the stock market is already off. So this is what really brings in the nuance, because a lot of people will say, and I could answer, I guess, the question that today's show poses, which is, are interest rates signaling a recession? You could look at the last two instances of interest rates in the late 90s, early aughts, in 2006, 2007, 2008, and correlate that to stock market crashes. And you could say, yeah, in those two instances, the yield curve inversion saw a stock market crash and a recession. But there's more nuance to this, right? First of all, interest rates are a lot more inverted than they were then. And the stock market last year, though we wouldn't call it a recession, obviously employment is still quite high. The economy is still, relatively speaking, for the last several years, outperforming. But last year we did see a NASDAQ that fell by around 20%, an S&P 500 that fell by around 15%. So have we already seen some of this stock market downside and economic recession? We've seen a little bit of it. And China and some places abroad have seen more of it than we have here in the U.S. So let's go a little bit deeper here and also rope in an even further out example in the 80s in just a second to see whether this is maybe not a yes or no situation, but an in-between and gray area, because yields are the most inverted that they've been since 1981. So far outweighing the inversions that we saw in the late 90s, in 2006 and 2007 there. As the difference between 10 years and 2 years has been lower than negative 1% or negative 100 basis points. And right now is pretty close at about negative 75 basis points. And those inversions historically, if we go back just a second, they bottom out at negative 50 basis points. So we've been pretty much double that inversion. And to find an inversion like this historically, to find an inversion that's more similar to our current more drastic inversion here, you have to go back to the high inflation that we saw in the 80s. Because if you dig deeper, and here we go, we're illuminating that gray area a little further, getting into that nuance. If you dig a little deeper into these past inversions here, these two that we started the show looking at, inflation wasn't nearly as high in those instances. There was some other stuff going on. And obviously you couldn't, the yield curve couldn't predict necessarily a dot-com bubble where these companies are pretending to be what they aren't, or a financial crisis where the lending system is getting out of whack. The inversion that we're seeing currently is largely inflation-based, and inflation got all the way up to 9%, which we didn't see since those early 80s. So let's go further back in time to get a closer essentially case study to today. And in the early 1980s, yields inverted by much more than they're inverted currently. Just to show you how bad it can get, looking at the Fed funds rate at top and the 10-year rate. So we've been looking at the 10-year the whole time, but now I'm substituting out the 2-year for what the Fed touches, which is an even shorter term interest rate, the Fed funds rate. The Fed funds rate got all the way up to 19% in 1981, while 10-year rates were just at 13%. So that's an inversion of 6%. We're currently around 1%. And in the last 20, 30 years, it's only gotten back as bad as 0.5%. So this is maybe a better example of what we're looking at. And at that time, inflation got up to double digits for a couple of years there in the late 70s, early 80s. And now I'm sure you at home, you historians or people who have been trading markets for a long time, will remember that the 1981 stock market and into 1982 was the biggest bear market until 2000, 2001. But here's what's interesting to me, and I guess you could say the same for the 2000, 2001 crash or the 07, 08 financial crash. The S&P 500 does tend to bounce back pretty hard. And you'll see that the bear market in this time frame of a 6% inversion in the early 80s didn't even hang around for a full 2 years. At its lowest, from high to low, the start of 1981 to the middle of 1982, the S&P 500 fell about 30%. Now, that's a big move. I don't want to diminish any of that. And unemployment in that time frame skyrocketed, was, I believe, double digits and then some. So, a real volatile time, a real recession there for sure. But if you're just looking at trading and just looking at the stock market here, by the end of 82, even though the stock market, the S&P 500 had fallen by the middle part of that year, year to date by about 20%, it closes the year up 15%. And then the next year, it eclipses where it was to start all of this bearish activity in 1981 by being up another 17% there in 83. So again, are interest rates signaling a recession? You look at historical inversions like we see now from the early 80s, the early aughts, the 2007, 2008 financial crisis. we have seen significant downside and volatility in the U.S. economy alongside these inversions, as we've seen in the last 16 to 18 months here already. But does this mean that the stock market has to be cut in half, or what some talking heads will jump on TV and say? No, there's more nuance to that. And so we'll watch for this. It's still developing. Obviously, inflation is still high. Our inversion is still going on here in the U.S. yield curve. But stocks have bounced back to a certain degree. They can go in either direction. We'll see what happens. If this stock market bearishness, if this recession that we've already kind of seen globally gets worse or better, the inversion is still very much there.
How to define economic recession. Yesterday, we looked into whether or not interest rates were signaling a recession, and I thought it would be apt to have a little conversation around what a recession technically is. And we can bring up the definition here from our friends at Oxford. You'll see that a recession is usually defined by being 2 quarters in a row lower in GDP. And the reason that I want to have a whole segment about it and explain this thing is recession is one of those ideas that floats around. A lot of talking heads will every week of the year, of every year, we'll be saying, well, I'm long gold. I'm 100% gold because recession is coming. What the hell do they mean? The noun definition here from the Oxford Dictionary tells you, well, look at GDP, 2 successive quarters lower, negative GDP, that is, negative growth essentially in your economy. That's what a recession is. And we can look at the recent GDP numbers and see if we are vulnerable to that. If we bring up the next piece here, you can find the last couple of quarters of GDP action as we went from around the start of the pandemic, relatively low GDP to, as you could imagine, in the later part of 2020 and the start of 2021, the stock market's making new highs. The companies of the stock market are making a bunch of products and selling the hell out of them. GDP was very, very high, north of 5% GDP growth in a couple of those quarters in 2021. We saw the flash of negative, and technically, in Q1, Q2 of 2022, you, I guess, could technically call that a recession, but no one was really calling it a recession. I wouldn't call it a recession. And that brings up this question of, like, even if we were to get a GDP print for Q2 of 23, that will be the next GDP here from the U.S., and Q3 as both being negative, is that really what a recession is? For us traders, we aren't watching for these 4 times a year of prints to define a recession. Let's take a look at the stock market and define it that way. And if we can bring up the historical chart for the S&P 500, I think we'll have an easier time here of defining GDP, setting aside GDP to define recession more in terms of price action, because yes, GDP is a big round number that lets you know what a region is producing and selling, and you can look at exports versus imports and all these different things. Or you can look at the stock market where all of those things are in a way baked in, right? Stock prices reflect earnings, and those earnings, what individual companies that make up the market are producing and able to sell and make in terms of profits and everything else, that measures in past GDP in real time, right? Apple and Microsoft, all these companies that are producing the gross domestic product, they're fluctuating in price continuously. At this point, pretty much 24/5, and in some places, 24/7, and also ropes in future employment. Another thing that people will look at is the unemployment rate low, is it high? Is employment low? And is that occurring for quarters in a row? Well, you know how you can tell if employment is going to be worse off in the future? If the stock price for all these big companies is crashing, they have less money to pay people and they're going to have to lay off workers. That'll let you know far in advance of a GDP number here. And you can see the most recent recessions that you would call reflected in the S&P 500 price action. They're in the early aughts and then in the 07, 08, 09 range. And I thought, let's zero in a little bit further on the most recent recession. If we can move on to the next chart here, you now can see, okay, I might look to price action in the stock market to define a recession. But now, is a recession 10%? Is it 25%? Is it 50% lower? Because if you set that at 50% lower, then at this point, you're not calling for a recession until over a year, 2 years almost, of price action. And it's like, well, Frank, thanks. I think at some point on the way to middle part of 2009, I would have known by now that a recession was afoot. 10%, that seems more like normal action. And you can actually see in the earlier part of 2007 there was a similar move and rebound to new all-time highs before the financial crisis and crash there of a 10% lower move. I think 25% or in that 20 to 30% range is where you can really start to feel like, oh, this is going to have a bigger economic impact. And that is a move that took essentially a little under a year there. But you can see it developing as it goes. And I don't think it's any coincidence that people were thinking last year about, and right now are thinking still, about the potential for a recession. The S&P 500 and NASDAQ were down around 15 to 20%, depending on where you were looking, and it felt like we were on the verge of a recession. So I think a better way to define things in terms of economic recession, yes, you can look to GDP, you can look to unemployment rates and everything else. They'll kind of tell you the same story. If you want to look on live, I think a movement from recent highs in the stock market of 20 to 30%, that'll pretty much set up how you could define economic recession. And another way that you could not only define it, but potentially look at predicting it, if we can get on to our last piece before our next segment here, is something that we've done work on in the past. And of course, I want to stay as far away from talking about predictions or recommendations or anything like that as possible, because every single market out there, be it stocks, interest rates, foreign exchange, everything, commodities, can do whatever the hell it wants at all times. But you look at the recent occurrences of yield curve inversions, and you could call it coincidence, you could call it randomness, whatever you want. But I will call out that there were yield curve inversions in the late 90s, and then we have the stock market crash, the recession there of the early aughts. And there were inversions in 2006, 2007 range. And then, of course, we have the financial crisis of 07, 08 right there following. Right now, we're even more inverted than then. So there is your definition for recession. Predictive nature for recession. It seems like interest rates is one of the best ways to measure whether or not a recession might be coming. The stock market might be the best measure of whether or not a recession is afoot. At the end of the day, use whatever measure you think is most apt.
How to invest during a recession, not quite in a recession right now. And is one coming? Well, it depends on who you ask. Make sure to check out some of the most recent episodes of In This Economy that we've done on how to define a recession or look for a recession via interest rates. But today we're going to build off of that definition of a recession to see how we might invest, or what historically has performed well during a recession. Just really quickly here, you can define recession as consecutive quarters lower in GDP. You only get 4 of those GDP readings a year, and they're very, very backward looking. You want something more real time, something more continuously updating you. You might look at a move lower in the stock market of 20 to 30%. That's where we landed on as being a decent middle ground between, a 10% stock move to the downside relatively frequent occurrence. Doesn't happen every day or every month, but happens, probably once or twice every year or so. 50% lower, we're already in a recession. So if you're looking to potentially hedge against a recession and the market's already down 50%, you may have missed that opportunity. 20 to 30% is usually a good tell of like, we're on the precipice of a real full-fledged recession. And I can feel like we're in the midst of it right now. Whereas being on the edge of that, we're down 10%, 15%, 20%. The stock market, especially the last 15 years here, has tended to bounce back from those moves. But once you break that point, it's historically been that we're in a recession. So the first thing you want to do when you're looking to hedge or essentially invest in the things that do well in any kind of environment, and here we're looking at a recession, is just look at the numbers. The numbers don't lie, and the correlations here are the numbers that we're looking at. And if we're defining recession as a 25% down move in the S&P 500, then it makes perfect sense that we would look at what is negatively correlated to the S&P 500, what moves up when the stock market moves down, and vice versa. And you can add some of these markets that are called flight to quality assets that include traditionally, the most traditional markets are bonds, gold, and there are literally funds that are created for passive investors to have X percentage invested in bonds, X percentage invested in stocks, with that built-in hedge against a recession or a stock market crash. And same with gold. A lot of portfolios will hold, 3% gold, 5% gold. Though actually it is interesting that the correlation there isn't so strong at negative 0.4. You would want a negative 0.5, negative 0.6 or beyond to really feel comfortable. It's a strong relationship there. And silver is actually less than negative 0.2 in terms of its correlation against the S&P 500. And then, of course, I might as well hit it while we're here. What you wouldn't want to be investing in the midst of a stock market crash or a recession is, I'm going to take my money out of the S&P 500 and put it in the Dow Jones. Very strong positive correlation. Same with NASDAQ, same with Russell. Makes sense there. You're not hedging against your stocks by buying other stocks. Now let's look at the most recent recession, full-blown recession that you might call, here in 2008 into 2009. I'm speaking to the financial crisis, to see how not only gold and treasuries acted, those traditional flights to quality, those traditional investments during recessionary periods, but also take a look at something that's less traditional and very difficult, to be honest with you, to invest in, the S&P 500 implied volatility. And you can see that throughout this period, all three of these markets shot up, especially in the fall of 2008 when the stock market really started to crash. But they did so to varying sensitivities. And that's what that correlation told us, which is that red line, the S&P 500 implied volatility, it had if I just go back really quick, the strongest negative correlation to the S&P. And that makes sense, right? Implied volatility is a measure of options prices. And if a market like the S&P 500 is crashing, people are usually buying more options. The price of options is increasing. Thus, the implied volatility measure within those option prices is increasing. So very direct relationship. Stocks down, option prices up, implied volatility up. But treasuries, there being the second strongest, you see a similar amount of sensitivity. If you zero in on that yellow box, when stocks really started to pick up steam to the downside in the fall of 2008, you see IV skyrocket quickly. You also see treasuries increase and then really skyrocket there, probably at the peak of stock market fear, recessionary fear there in the early part of 2009. gold, while you might say, oh, well, gold saw this coming. I don't know if you could say that exactly. And that's why gold increased between the middle part of 2007 and the middle part of 2008, prior to the actual crash in the later part of '08. I think that gold, similar to interest rates, can kind of sense a lot of times fear, but you must put the disclaimer on that there's a lot of times where gold and interest rate inversions, that is the yield curve, not just interest rates in general, but that yield curve inversion and gold prices can sense a little bit of fear and move in the correlating direction of fear and then dissipate. There's plenty of times historically where that's happened. So it's hard for me to, especially with the numbers showing gold to have the lowest of these three, the least strong of these three correlations, and the fact that when all hell breaks loose in the later part of '08, and implied volatility is rising and treasury is rising, gold is moving back and forth. Look at that orange line within the yellow box. Gold is falling, it's rising, it's falling, it's rising, without any real rhyme or reason. Gold can sometimes trade risk on and trade risk off. So it is a good traditional flight to quality, but it's less consistent, I would say. Now, the other piece, the elephant in the room, is Warren Buffett saying, Frank, remember that when people get fearful, that's often the best time to get greedy. I believe that was Warren Buffett. I hope I don't have that wrong. Sorry to whatever old billionaire quoted that. But should you also just be investing in stocks? Because you might say, oh, man, I wish I was around during the dot-com bubble, or I wish I was around during the financial crisis to scoop up all these stocks. Easier said than done, especially if you try to catch that falling knife too early. But it is historically a solid strategy to not necessarily, oh, I'm in the midst of a recession, I'm going to dump out of all my stocks and just buy all this gold or all these bonds. Because, looking back at this chart really quick, when the fear subsides in 2009, all of these markets come back in. So you don't want to necessarily buy those at their peak. Get out of your stocks when stocks are at their lows. But if a recession is afoot, taking some of that stock investment, putting it into gold treasuries, or if you think that a recession is coming, doing that beforehand, obviously more advantageous. But also maybe carrying around some cash, this is why a lot of people will have, say, a $10,000 account and leave, $1,000, $2,000 sitting around, because price averaging or cost averaging buying stocks on the downslope is historically an advantageous strategy, as the stock market has always recovered, right? We put in new all-time highs as recently as 2 years ago, but that can last 5 to 8 years. You look here from the start of the dot-com bubble to the end of it, that's 2000 to about 2007, and then that's just in time for the financial crisis, and the market takes another 5 years to recover from that. So at the end of the day, Frank, what the hell do you want me to do? Diversify, my friends. And the more that you're worried, the more that you can diversify there. So it's a matter of, I'm not that worried, so I'm going to be 90% stocks and maybe 5% bonds and 5% cash. Or I'm getting more worried. I'm going to go into 75% stocks, 10% bonds, 10% gold, and 5% laying over for potential more stock investment if the market does fall. That's diversification, one of these buzzwords that these big scary words that's like, oh, I'm learning how to invest, I need to diversify. What does that exactly mean? It makes total common sense, right? You don't want to be concentrated in one thing, especially for a recessionary period. You don't want to be, you're not diversified to own the S&P 500, Dow Jones, and the NASDAQ. You're relatively diversified, but not necessarily ready to invest in recessionary period. So there you go. The key to investing during a recessionary period is just trying to be as diversified and risk management savvy as possible going into such an event or throughout it as well.